Welcome to Finantax Clips. Ever wondered about the differences between commercial debt and single-family real estate loans? Well, you've come to the right place. Navigating the world of real estate financing can be a daunting task, with terms like commercial debt and single-family real estate loans often thrown around. In essence, commercial debt refers to loans secured by businesses, often for purchasing commercial properties or financing large-scale operations. On the other hand, single-family real estate loans are typically used by individuals to buy residential properties. Grasping these distinctions is fundamental for anyone aiming to invest in real estate or seeking financing. It's not just about understanding these terms, but more importantly, knowing how they can influence your investment strategies and financial plans in 2024. So, buckle up and get ready for an insightful journey into these complex financial concepts. Join us today as we break down these complex financial concepts. Please remember to subscribe, like, and share our content. To start off, let's delve into what commercial debt really is. Commercial debt, in its simplest form, is money borrowed by a business or commercial entity from a lending institution. This borrowing is typically done to fund major capital expenditures or cover operational costs that the business may not be able to afford upfront. It's a financial tool that can spur growth, finance expansion, or even keep a business afloat during tough times. Commercial debt can come in many forms. It could be a business loan from a bank, a line of credit, or even a commercial mortgage on a property. What makes it different from personal debt is that it's tied to the business, not the individual. This means that the business, rather than the individual, is responsible for repaying the debt. One key feature of commercial debt is that it's often secured. This means that it's backed by some form of collateral, such as a piece of property or equipment. If the business fails to repay the debt, the lender has the right to seize this collateral to recoup their losses. This lowers the risk for the lender, but it also means that the business could lose a valuable asset if they default on the loan. Who can benefit from commercial debt? Essentially, any business or commercial entity that needs funding can. From small startups looking to get off the ground, to large corporations planning major expansions, commercial debt can provide the capital needed to achieve these goals. However, it's not a decision to be taken lightly. Like any financial tool, commercial debt comes with risks. Businesses must weigh the potential benefits against the possibility of default and the loss of collateral. It's crucial to have a solid repayment plan in place and to only borrow what's necessary. Now that we've got a grip on commercial debt, let's contrast it with single-family real estate loans. Moving on, let's unravel the concept of single-family real estate loans. At their core, these types of loans are designed to support the purchase or refinancing of a detached single-family home. They are what most people imagine when they think about a traditional mortgage. Now, the purpose of single-family real estate loans is quite straightforward. They provide a way for individuals to purchase a home for their own use or as an investment property. This type of loan is typically repaid over an extended period, often spanning 2 to 3 decades, and is structured in a way that the borrower pays back both the principal amount of the loan and the accrued interest. So, how do they work exactly? Well, once a borrower is approved for a single-family real estate loan, the lender provides the funds for the home purchase. The home itself then serves as collateral for the loan, which means if the borrower fails to make timely payments, the lender has the right to seize the property. Who are these loans designed for? Primarily, single-family real estate loans are for individuals or families looking to buy a standalone house. However, they can also be utilized by investors seeking to purchase a single-family home as a rental property. Key features of single-family real estate loans include their long-term repayment schedules, fixed or variable interest rates, and the requirement for the borrower to have a good credit score. They also often require a down payment, usually between 5 to 20% of the home's purchase price. One of the main advantages of this type of loan is its accessibility. Many lenders offer single-family real estate loans, and there are numerous loan programs available, each catering to different financial situations and needs. However, it's important to note that while single-family real estate loans can be an excellent tool for home buyers and investors, they also come with risks. As with any loan, failure to meet repayment obligations can lead to significant financial consequences, including the loss of the property. With a clear understanding of both concepts, we can now look at how they differ. So how do commercial debt and single-family real estate loans differ? Well, let's start by looking at the criteria. Commercial debt is typically granted to businesses or investors looking to purchase or renovate income-generating properties. These could be office buildings, retail stores, or multifamily apartments. The creditworthiness of the business, its financial health, and the potential profitability of the property are all considered. On the other hand, single-family real estate loans are primarily granted to individuals looking to buy or refinance a home for personal use. Here, the borrower's personal credit score, income, and the value of the property are the key determining factors. Next, let's consider repayment terms. Commercial loans often have shorter terms, generally between 5 to 20 years, with a balloon payment at the end. This means that while you'll be paying off the interest during the term, the principal amount will be due in full at the end of the term. Single-family loans, on the other hand, usually have longer terms, most commonly 30 years, and are fully amortizing, meaning you pay off both the principal and interest over the life of the loan. Now, on to interest rates. Commercial loans typically have higher interest rates than single-family loans. This is due to the increased risk associated with commercial properties, which can be affected by economic conditions more so than residential properties. Also, commercial lenders often set their rates based on the riskiness of the business and the property's profitability. Conversely, single-family loan rates are more influenced by the borrower's personal creditworthiness and the general market conditions. Finally, let's talk about risk. With commercial loans, the risk is often higher. If the business fails or the property doesn't generate enough income, the borrower may default on the loan. And due to the balloon payment structure, there's the risk of being unable to pay off the principal at the end. Single-family loans, on the other hand, are considered lower risk. People always need a place to live, and the housing market is generally more stable than the commercial property market. However, there's still the risk of default if the borrower's personal financial situation changes. In sum, commercial debt and single-family real estate loans each have their unique set of considerations. They differ in their criteria, repayment terms, interest rates, and risks. Understanding these differences is key for anyone navigating the real estate market, whether you're a business looking to invest in commercial property or an individual seeking to buy a home. We've contrasted the two, but how do they compare? Stay tuned to find out in the next segment. Now let's shine a light on how commercial debt and single-family real estate loans compare. As we delve deeper into the financial labyrinth, it becomes evident that commercial debt and single-family real estate loans, while seemingly different, do share some common ground. They both serve as critical financial tools for investors, enabling them to leverage their capital and maximize their investment potential. Both types of loans are designed with the same fundamental purpose: to provide the borrower with the necessary funds to purchase property. Whether you're a seasoned entrepreneur looking to expand your commercial property portfolio or a first-time homebuyer, these loans are the financial stepping stones that can help you reach your real estate goals. Additionally, both commercial debt and single-family real estate loans offer the potential for considerable financial gain. For commercial loans, this could mean the income generated from leasing or selling the commercial property. In the case of single-family real estate loans, this could be the appreciation of the property value over time or rental income if the property is let out. However, let's not forget that with great potential benefits come potential drawbacks, and this is true for both types of loans. Both commercial debt and single-family real estate loans carry the risk of the borrower defaulting on the loan. If the borrower is unable to repay the loan, the lender has the right to seize the property, which can result in significant financial loss for the borrower. Moreover, both types of loans are subject to interest rates, which can fluctuate based on various economic factors. This means that the cost of borrowing can increase over time, adding to the financial burden of the borrower. Therefore, it's crucial for borrowers to factor in potential interest rate increases when calculating the overall cost of the loan. However, despite these similarities, it's essential to remember that commercial debt and single-family real estate loans are not interchangeable. Each type of loan has unique characteristics that make it more suitable for specific situations. For instance, commercial loans typically involve larger amounts of money and longer repayment periods than single-family real estate loans. On the other hand, single-family real estate loans often have more flexible repayment terms and lower interest rates than commercial loans. In conclusion, while commercial debt and single-family real estate loans share some similarities, they also have their unique features and potential drawbacks. When deciding which type of loan is right for you, it's essential to weigh these factors carefully and consider your long-term investment goals and risk tolerance. As we've seen, while they serve similar purposes, their differences can significantly impact your investment strategy. To wrap things up, let's summarize what we've learned today. We've embarked on an engaging journey, exploring the dynamic world of commercial debt and single-family real estate loans. We've dived deep into their distinct characteristics and how they can potentially influence your investment strategies in the year 2024. Commercial debt, as we've discovered, is a broad category of loans aimed at businesses and corporations. These loans can be used to finance a wide range of commercial properties, from office buildings to shopping centers. They often come with higher interest rates compared to single-family real estate loans due to the increased risk associated with commercial properties. However, they also have the potential for higher returns, making them appealing to seasoned investors. On the flip side, we have single-family real estate loans. These are primarily used by individuals to purchase residential properties. Unlike commercial debt, the interest rates for these loans are generally lower, making them more accessible to first-time buyers or those with less capital to invest. However, the returns on these investments are also typically lower, reflecting the reduced risk. While they may seem worlds apart, both commercial debt and single-family real estate loans share some similarities. They both require careful consideration of the property's value, potential return on investment, and the borrower's ability to repay the loan. Both also offer the opportunity for asset appreciation over time, making them viable long-term investments. Understanding these key differences and similarities between commercial debt and single-family real estate loans can significantly impact your investment strategy in 2024. It's all about weighing the risks against the potential returns and choosing the path that aligns with your financial goals and risk tolerance. We hope this breakdown of commercial debt and single-family real estate loans has been helpful. Remember, understanding these differences can be crucial in shaping your investment strategy in 2024. Thanks for watching.